This is David Evans. I'm here today with Vitas Katselias, who's the CEO of the Collection Marketing Center. Vitas, what is the Collections Marketing Center, and what problem in the payment system is it trying to solve?
Collections Marketing Center, or CMC, is a software company, and we have a platform that helps lenders do a more efficient and effective job in collecting payments from either delinquent debtors or, in some cases, written off accounts, and in other cases, pre-delinquent accounts.
And how did you get into the business? What's your background?
So I have been in the financial services space my entire career, starting with IBM a long time ago, and most recently in a couple of more emerging growth companies. The last of which was an interactive voice response company I co-founded. And as we got into the collections application and learned what we were trying to achieve by automating interactions, we found that one channel, IVR alone, just wasn't as effective as becoming a fully knit-in part of the fabric of the collections operation. And so I joined with a consulting firm that were specialists in credit and risk policy, called Bridgeforce, and we founded this company, CMC, to try to solve that very problem, which is that when you have disjointed, disconnected communications that are happening sort of in their own silos, you lose both efficiency, because you're spending too much in each of the individual silos of communication. You're losing effectiveness because your message is diffused and in some cases contradictory, and in other cases just confusing to the debtor. And finally, with the way that both the economy is headed and just our environment in total, people are more and more comfortable interacting via the self-service, more automated channels, and the collections industry, unfortunately, has been way behind in adopting that. So you find people still doing the smile and dial kind of tactic that's less and less effective.
You wrote a paper recently with Julie Austin at TSYS. You guys talk about how the payments business really needs a full channel approach for collections. What's the full channel approach, and how is that different from what collection organizations are doing today?
Sure. The current sort of state of the art is, even with the largest banks who have invested in various technologies like emailing and text messaging and having web-based collections, in addition to their auto dialers and their IVRs and their and letters that they send, those communications are disjointed, and therefore, from the consumer's point of view, it feels like the dialogue goes in fits and starts. And when I say the dialogue, I don't just mean the communications channels. I mean the content. What offers are they making me? What happens when I speak with an agent? Because the agent's never going to go away. They're an integral part of the process. The problem is that when those communications are all done with offers and treatments that maybe are inconsistent, or worse, appear to be inconsistent to the debtor even when they're not, then breakage in the process. What we've done at CMC is knitted all those things together so that you can have a single dialogue with that debtor, regardless of whether they come to the website and look at offers and then interact with the IVR to close out their program or speak with an agent. The benefit of this full channel, this full spectrum approach to the dialogue, is that from the debtor's point of view, and let's remember, the debtor's always known the whole dialogue. The debtor's always known what you wrote them in the letter, what you said in your IVR message, what the agent said, and what they saw on the website. So they've always been ahead of us in knowing the full state of the dialogue from their point of view. And so what we've done with this automation platform that we call FlexCollect is we give the lender a way to understand that full dialogue. That has two main benefits. One is the financial benefit and efficiency and effectiveness. But secondly, from the customer's perspective, you're now treating them with a dialogue that makes sense, and that has an implication on your ability to retain customers down the road. A lot of today's first-time delinquent customers are tomorrow's great customers, and you want to retain them, not push them away or make them regret doing business with you during this.
Isn't it going to be costly and take a long time to implement?
Well, it isn't with the platform that we've built, which plugs in as a managed solution to whatever collection system is already in place. The bigger change is sort of a philosophical paradigm shift where most collections platforms have been oriented toward putting all the power in the hand of the collector and trying to make sure that that collector's talk-off, in industry terms, is the right one. We've, in fact, created a platform that allows the strategist and the manager of collections to sort of set all the dials and run the show, where the collector is an integral and important part of the dialogue, but only one part, where the strategist can manage, for example, with David, who's low risk and a medium-sized balance, I'm going to go with lower cost, more self-service channels in a higher percentage of my attempts than with Vitas, who's higher balance and higher risk, and I want to try that, and if he doesn't respond quickly, I'm going to move him into an agent conversation. Similarly with the offers that I make, David being low risk, I might be willing to do things with David in a programmatic way or actually not willing to make as many concessions because David's low risk and I think he will pay, whereas Vitas being high risk, I might have to go a little bit deeper to get a payment at all from Vitas. And the risk here is not that either of us will charge off, but in the percentages, we know that what will happen is that some people will charge off, and I want to maximize my yield by having the right program for the right person. So I want the programs very individualized based on risk, balance, and other factors.
And how is CMC using this approach to help lenders today?
So in our platform itself, we have the decisioning capability and the rules capability that allows customers to have an unprecedented both flexibility in the programs that they create and transparency to what's happening across all of the different offers and the customer's responses by channel. But the other part of it is that we get pretty actively engaged in working side by side with our clients. We have a lot of domain expertise in our team in collections, and we work with our customers to make sure that they can start with strategies they're already deploying and be very comfortable to be quickly up and running with this managed service platform, which means they don't need to put in software, they don't need to put in any hardware to make this work. And we work side by side to make sure that they're comfortable in their progression through simple strategies to more complex strategies, like what do I do when someone comes to the website and doesn't make a payment but looks at an offer? Do I want to make them a new offer? Do I want to inform them about it with an email or a text or an interactive voice call, or do I want to put them in an escalation queue to agents? All those kinds of decisions are new to many organizations that haven't been able to do full channel. So we work hand in hand with our clients on a sort of consultative basis to make that transition easier.
We still have unemployment hovering around 10%. A lot of people have taken pay cuts and are hurting financially. I haven't looked at the statistics recently, but I think if you take the unemployed and the discouraged workers and people that have taken a significant cut, it's probably somewhere in the neighborhood of 20% or so of the workforce. How is the economy today affecting the collections business, and how's 2010 going to be for default and for collections?
Well, that last question is one that all of the economists who are much smarter than I can give you their opinions, and they differ quite widely. But the reality is that
you're touching people all the time, so you in a sense have almost better real world information than economists do.
Well, exactly. And the economists look at things like what's the default rate when that's a summation of a number of different factors, like how many new loans have come on the books since the last couple of years, so we've already tightened credit practices. So the statistics can be a little bit misleading. But what our clients are telling us is that they don't anticipate at least in the lending side for credit card loans and auto loans and mortgage and home equity loans, they don't anticipate things getting much better in 2010 until the unemployment rate has peaked and started to go back down. So it's traditionally in the industry lagged behind unemployment rates. So if you look at a graph of unemployment versus default rates typically lag somewhere between 3 and 6 months because all of those people, when they immediately get a job, have a lot of debts and other things that they're trying to deal with. So it doesn't just fix itself immediately. But long story short, we envision that lenders are going to have to be nimble and very flexible and creative in their thought process about how to deal with more and more customers that are having difficulty